Welcome to Rich Tribe. Look, for years, I've watched people absolutely exhaust themselves chasing after the next big thing. You know what I mean? Crypto pumps, day trading, incredibly complex option strategies. They really think that's the only way to build actual wealth. But let me tell you, building generational wealth, it isn't about hype, and it for sure isn't about getting lucky. It's about a deeply strategic, quietly confident approach that just works entirely in the background. So in today's explainer, we're going to break down the absolute best beginner investment strategy to build true, lasting wealth.
And I want to kick things off with a question that might honestly challenge everything you think you know about money. What if the absolute secret to building millionaire wealth was entirely, completely boring? Okay, John, I gotta stop you right there. Boring? Literally everyone online is talking about timing the market, finding that next massive breakout stock, or flipping real estate. You're seriously telling me the ultra wealthy are just sitting around being boring? Come on. I highly doubt traditional, unsexy financial advice is what's buying those super yachts.
Section 1, the wealth building secret. I hear you, Rachel, I really do. It sounds completely counterintuitive, but the investors who actually build real wealth over time, they usually aren't doing anything flashy at all. The core secret is something called an index fund. Instead of pulling your hair out trying to find a needle in a haystack by picking one winning stock, you just buy the entire haystack. Okay, but do the ultra-rich actually use something that simple? I'm going to need some proof here because I feel like billionaires have exclusive secret hedge funds, not just basic index funds. That is a very fair challenge. So to prove it, let's look at the literal instructions left by history's greatest investor, Warren Buffett. The guy put his money where his mouth is in his actual will. His instructions for the money left to his wife are stunningly simple. Put 10% into short-term government bonds and 90% into a very low-cost S&P 500 index fund. That's the whole shebang. Even a billionaire's estate plan relies entirely on the boring reliability of low-cost index funds.
And this leads us perfectly into what is famously known as the Boglehead Blueprint. It's a strategy built on incredibly low costs, automatic diversification, and literally zero daily maintenance. And here is the real kicker. A boring index fund strategy consistently beats 90% of professional money managers over any 20-year period.
Wait, seriously? So the professionals whose entire full-time job is to beat the market just can't? That's wild. But John, if I just go out and buy a massive basket of stocks like the S&P 500, how does that actually protect me from a massive market crash? You're still fully in the stock market, right?
Exactly. You are in the market. Which brings us to the magic of diversification and asset allocation. Picture a street vendor who sells both umbrellas and sunglasses. Now, initially that seems kind of odd, right? When would a single person ever buy both at the same time? Probably never. But the vendor knows that when it's pouring rain, the umbrellas sell out, and the sunglasses just sit there. When it's sunny, the exact reverse happens. By holding a mix of assets, like U.S. stocks, international stocks, and some bonds, you dramatically reduce the risk of losing your shirt on any given day. You balance your portfolio so absolutely no single economic storm can sink you.
Okay, I get it now. So when one part of the portfolio takes a hit, the other part holds steady. That makes total sense.
Section 2, Master Your Investing Psychology.
But, John, think about this for a second. If the strategy is literally just buy the haystack, balance it out with some bonds, and do absolutely nothing, why do so many people fail at investing? Why do we constantly hear stories of people losing everything?
That is the million-dollar question, Rachel. If the math is so incredibly simple, what goes wrong? Well, the painful answer is we do. Our own brains are the absolute biggest enemy of our wealth. Behavioral finance teaches us that human beings are just fundamentally irrational creatures. We basically face two main types of biases. First, you've got cognitive bias. This is when your brain tries to create a quick mental shortcut to simplify complex information, but it ends up leading to a massive error in judgment. Second is emotional bias. This is making huge financial decisions based on fear or greed, basically how you feel in that exact moment rather than looking at the objective facts.
Wow. Yeah, I can definitely see how fear completely takes over when you log in and see your account balance dropping like a rock. Are there specific traps that beginners usually fall into?
Oh, absolutely. One of the most destructive ones out there is called the snakebite effect, and it's deeply tied to something called loss aversion. Psychologically speaking, it literally hurts us twice as much to lose a dollar as it feels good to gain a dollar. So when the market drops, people absolutely panic. Just look at the 2008 financial crisis. The market crashed, and tons of new investors completely panicked and sold everything they had right at rock bottom. They felt snake-bitten. And because of that intense emotional pain, they refused to ever put their money back into the market. Because of that, they completely missed out on the massive, historic recovery gains that followed over the next decade. Their emotions permanently locked in their losses. Section 3. Timing versus time and market. Gosh, that is just tragic. They did the exact opposite of buy low, sell high. Okay, so speaking of timing things, here's a massive debate I hear literally all the time. Let's say I come into a big chunk of cash, maybe a bonus at work or an inheritance. Do I invest it all at once, or do I slowly spread it out over a few months so I don't accidentally buy in right before a market crash?
Yes, the classic debate. Lump sum investing versus dollar cost averaging. You're basically asking if you should try to time the market. Vanguard actually did a massive comprehensive study on this exact question. Mathematically speaking, investing a lump sum all at once beats dollar cost averaging about 67% of the time. That's 2/3 of the time.
Wait, really? Dumping it all in at once is actually statistically safer for my overall returns?
Yes, and the reason why is actually pretty simple. Markets go up way more often than they go down. Historically, the US stock market posts positive returns in about 75% of all 12-month periods. Every single day your cash just sits on the sidelines, it's missing out on that upward momentum. Now, obviously, if spreading it out helps you sleep better at night and keeps you from panic selling, then sure, do it. But strictly mathematically, time in the market always beats timing the market.
Section 4. The magic of compounding.
All right, so now that we know how to actually get our money into the market without letting our emotions totally destroy us, let's talk about how the money actually grows once it's in there. Let's look at the sheer, undeniable math of wealth. Take a look at that massive number right there, $346,659. This is the pure result of compounding. If you invest just $5,000 a year for 15 years, say from age 35 to 50, at an average 7% return in a tax-advantaged account like a Roth IRA, this is what you get. Think about it. You only put in $75,000 of your own hard-earned money. The rest of that, it's pure compound growth. That is just incredible to think about. So the money makes money, and then that new money makes even more money. It's exactly like a snowball rolling down a hill getting bigger and bigger. But John, what happens to this snowball when the market inevitably crashes?
And that right there is where this strategy gets incredibly powerful. When you invest in index funds, the massive companies inside them pay you dividends, which is basically a slice of their profits. You want to set up a DRIP. That stands for a dividend reinvestment plan. This automatically takes those cash dividends and buys more shares of the fund. During a market crash, share prices are incredibly cheap, so your dividends are automatically buying more shares at absolute fire sale prices. This creates what we call dividend hypercompounding. You are literally turning market panics into a wealth-building engine completely on autopilot, keeping all of your emotional bias completely out of the equation. Section 5. Rethinking the housing dream. Okay, that makes a lot of sense for stocks. But John, I have to challenge you on the ultimate middle class assumption here. Literally everyone says your primary financial focus should be buying a house. Isn't renting just throwing your money down the drain? Shouldn't my biggest, most important investment be a home?
I am so glad you brought this up, Rachel, because treating your primary residence as your ultimate investment is a massive trap that keeps millions of people from becoming truly wealthy. We really have to compare apples to apples here, using irrecoverable costs. Yes, when you rent, your rent check is an irrecoverable cost. But when you buy, your borrowing costs from the mortgage, your constant maintenance, your property taxes, those are all irrecoverable costs too. But here is the absolutely biggest cost of all, opportunity cost. If you sink $400,000 into a down payment, that money is trapped in brick and mortar. If you rent it instead and put that same $400,000 into the S&P 500, historically, it yields about 10% annually. That's $40,000 a year in pure growth, which, by the way, often completely covers the cost of your rent anyway. Tying up half your net worth in a single, highly illiquid asset in one specific neighborhood is actually incredibly risky compared to just holding a globally diversified portfolio.
Section 6. The ultimate beginner blueprint.
Wow, when you lay out the opportunity costs like that, the stock market actually seems way safer and honestly more lucrative than buying a house. Okay, John, I'm fully sold on the philosophy. I really want to put this millionaire strategy into action. Can you give me the concrete step-by-step summary so I can start today?
I will absolutely give you the exact blueprint. But before we reveal the final steps to lock in your generational wealth, please subscribe to Rich Tribe channel, like, comment, and share. We are building an amazing community of focused learners who want the real truth about money, minus all the internet hype.
All right, here is your foolproof, fully automated blueprint. Step 1, open a Roth IRA. You pay taxes on the money now, and all that massive compound growth we talked about is tax-free forever. Step 2, buy a total stock market index fund or an S&P 500 fund. Don't overthink it, just buy the haystack. Step 3, Automate your contributions. Set it up so the money leaves your checking account every single payday before you even have a chance to spend it. This enforces strict discipline and brilliantly utilizes dollar cost averaging if you don't have a big lump sum to start with. Step 4. Avoid clever trends. Day trading and crypto speculation absolutely destroy young portfolios. Remember, this boring strategy beats 90% of Wall Street professionals over 20 years. Be boring, get rich. And I'll leave you with this final, crucial thought for today's explainer. Because of inflation, your money is literally losing purchasing power every single second it just sits there in a cash checking account. You simply don't have the luxury of waiting around for the perfect time to start. The math absolutely demands action. So, knowing what you know now, what is your first move today? Take control, automate your wealth, and start building your future.